Hello, this is Rich Morrison, and welcome to my latest edition of the Thinking Cap, where today we're going to do a quick commodity market update. We're going to run through many markets here in just a few minutes, kind of give you an idea where things are at starting the day, starting the week. It is Monday morning. We generally have a lower trade. There's some reasons for that we'll talk about here in just a second. And so let's dig right into the markets. What's going on right now? Well, to me, these are the biggest factors still in the marketplace for ag. We've got large U.S. stocks of basically the big four crops right now: corn, beans, harvesting a record or near record crops. Wheat, we've still got large stocks that grew this year. Cotton stocks, not tight by any means at this point. One of the big stories over the last month or so is that the funds have covered their huge short positions that they had all summer long, and so that gave us a little bit of a rally. Why wasn't the rally bigger? Well, it was because it was offset by some pretty massive farmer selling, especially late summer, as we liquidated a lot of old crop grain that was in the bin. South American prospects, even though they're a little late getting started with planting, off to a pretty good start, and the weather has changed. And we look at the patterns down there, things have moved a little bit, seeing some better rain opportunities through Mato Grosso do Sul, some of the key growing states in that country. And then finally, the macro influences. And we're seeing a lot of movement here in the macro markets here the last 3-4 weeks. And so we'll start out there with those commodities and then work back into the crops. And so looking at the gold market right now, I mean, holy cow, gold continues to make new record highs, it seems like every day. We're pushing a little bit lower here today, but nonetheless, it's been a big push over the last several months, really. I mean, you go clear back to February, we're $2,100 an ounce. Now we're $2,750 an ounce right now. The 9-day moving average on December gold, the red line, continues to be pretty good support. So not that that has a big impact one way or the other, I don't think, on the ag markets, but generally commodities. If one market tends to move, tends to pull some of the other ones. The dollar, this has had a negative impact, I guess you'd say, but even with that, we've seen good export business, but we've seen real strength in the dollar lately, and a lot of that is flight to safety. When people are, and you could say that in the gold market too, maybe some nervousness around the U.S. election, maybe talk about tariffs, say, on China, on Mexico, et cetera. And so that has maybe strengthened the dollar a little bit. But this is giving a little bit of headwind, I think, to to even potentially more export business. We've seen some pretty good business, could have even seen more had the dollar not strengthened so much. The crude oil market. Big negative in the market here this morning was oil dropped sharply here at the open this morning, gapped lower. We're trading around 67.50 a barrel right now, mid-morning on Monday. And biggest reason for that was the strikes from Israel into Iran overnight, over the weekend, did not include any oil facilities. And so the trade, I think, had feared that at the end of the week, that there could be some tax on the Iranian oil. Didn't happen. And so you've seen oil sell off sharply this morning. Why is that a big deal? Well, this is a pretty interesting chart that Susan Stroud had put out recently, showing the comparison between oil and corn futures. Tend to track pretty well over time, not necessarily every day, but certainly over time. And so the strength in oil lately has, I think, lifted corn. The negative tone here today is certainly a negative for the corn market. And before we get into the crop markets, we'll look back at last Friday's Commitment of Traders report. Showed that the funds were net just slight buyers overall in the crop markets and grains and oil seeds. But you can see, I mentioned at the beginning that they had covered this huge short position. Had been record short back in the spring. We're still short nearly 700,000 contracts in grains and oil seeds here, even as of almost the 1st of September, but covered that entire short position, and now back to just a small short position, which is pretty common for this time of the year to see them trading a little bit on the short side of the market. The only years that wasn't the case, certainly 21 and 22, when we took prices really high, the funds were long. That was when we were seeing China in the U.S. corn market. And then you got to go clear back, well, 2020 as well. And so that period seems to be behind us now. The market seems to be more in a big stock type situation like we were in 19, 18, 17, et cetera. So which ones are the hot and the not markets? This is from Friday night's market report email letter, the heat check column. We had the dollar, we had the livestock markets, live cattle, hogs, rapeseed, gold, all in the hot market, which means we had the relative strength indexes above 60. The RSIs were in the 80s, or excuse me, the stochastics were up into the 80s, even 90 for live cattle. And so all of these markets probably a little toppy. And so kind of beware of that. Now we've seen the dollar already start to kind of turn lower a little bit. Gold, kind of sideways to easier here this morning. The not markets were led by the wheat. Chicago, Kansas City, Minneapolis wheat. We weren't quite below 40 in the RSI, but you had stochastics showing that these markets had really tanked in a hurry. Even the Minneapolis market cleared down to 8. So that's certainly the most bearish of the crop markets. So starting out looking at the crop markets, we'll start out with corn. One thing you'll notice on here is this big green line. This is the harvest revenue price for crop insurance. That will be final 3 days from today on Thursday night's close. Currently, we're down 10.5% from the revenue-based price set back in February. The margin protection price is down 18.1% from what was set back in September last year. So I would assume that in some counties this year, the high level policies like margin protection and ECO at 95% probably will start to trigger some indemnity payments, but in particular margin protection, given the fact that we're down 18% on price. Looking at the chart this morning, some good and bad. At the end of the week, we went back below the 100-day moving average line. Here this morning, we're holding right now at the 9-day moving average at 412.25. We'll see if we can hold that into the close. If not, 410, the 50-day moving average comes into play. But one thing I notice here, we're entering that time of the year that it seems like the last several years where you start to see all of these moving average lines come together. These colored lines, they start to come together, which means we're seeing less volatility in the corn market. Why is that? Well, we pretty well know the size of the crop at this point. That's not really, we could tweak it a little bit, but it's not going to change a whole lot at this point. Demand is kind of coming into focus a little bit better. Again, USDA will make some tweaks to the demand numbers, but not any huge numbers. So we know that corn stocks here in the United States are going to be, 2 billion bushels, plus or minus 100 million. So there's really not a whole lot that's going to change in the balance sheets, and therefore really not a lot of risk reward, for traders. And so you're seeing volatility sucked out of the market. Not a bad opportunity for guys that have to sell grain off the combine to maybe cover it with a call option, because the calls are going to be a little cheaper here as we go forward. And again, if you look at the indicators, the RSI at 49, stochastics in the 50s, pretty neutral market right now. So I think we're going to be kind of in a sideways trade, probably see these highs and lows start to come together a little bit over the next 3 to 4 months, once you get, until you get out into maybe Jan, Feb, something like that. Soybeans, we're trading at the lower end of the recent range. Why? Well, probably the change in the weather patterns in South America, the biggest factor. Certainly, yes, we're harvesting a huge U.S. crop, seeing a lot of beans sold off the combine, but also keep in mind, that South American crop's a lot bigger. And if they hit, look out. We're going to have a lot of beans this year. And I continue to say that I think beans at the world level have the most bearish balance sheet there is right now of all the crops. And so these prices continue to work lower. So I do want to sell rallies in beans, be fairly aggressive. We haven't had a whole lot of one lately. We've fallen back below the 9-day moving average line this morning. Not a good sign. Certainly we could go back and test last week's low. Can we go back and test the August low? Yeah, if the rains continue in South America and the planting progress picks up, certainly could be the case. So I would like to sell the rallies here. The RSI 39, stochastics, we're probably moving this into the not zone here this afternoon. In Chicago wheat, new low this morning. That probably directly because of the forecast. And even though it doesn't maybe impact Chicago or soft red winter wheat as much, we are seeing some really good forecasted rains in hard red winter wheat country here in the United States. probably into soft wheat country as well. So we know that the drought monitor has increased in size over the last several months, and it looks like we are, knock on wood, going to get a little help over the next 5 days, 10 days throughout much of the country. So, and we're just not seeing new sales coming out of the United States. So we've got the RSI at 40, stochastics down in the teens. Market's pushing into oversold territory, but that doesn't mean we can't continue to push lower. Same with the Minneapolis, same with the Kansas City wheat. Finally, in cotton, cotton market just doesn't seem to have any friends. It seems like, we get news that China is going to try to pump up its economy with some stimulus, and we rallied cotton 8 cents off the low, and then that stimulus doesn't seem to be doing much, and we're not getting any business out of it. And so the market has been disappointed, and over the last 3 to 4 weeks has been selling lower once again. So we're back below the moving average lines. RSI at 42, stochastics moving closer into oversold territory. Again, not a surprise if we were to push back below 70, but 70 cents seems to, for the moment at least, knock on wood, be some decent support here. Also want to mention we're down 12.1%. From the base price in cotton for many states. What does that mean? Well, it means that if you had stacks coverage, say at 90%, that there's a possibility, depending on your county yield, you could see a stacks payment this year based on the price drop. So we'll keep an eye on how the month finishes here. Switching over to the livestock, positive news, I guess you'd say. The cattle on feed report on Friday afternoon was neutral. 100% of last year's cattle on feed. However, placements in the month of September were only at 98%, which I think should be a little supportive, especially to the feeder market. But look at the cattle market right now. It's been in the hot zone, as I mentioned earlier. Probably warranted a sale here. We've pushed back against the summer highs at 190. Good place to be hedging or selling some nearby cattle, or even some deferreds as well. So, or consider the crop insurance programs with some of the policies that we've got available there. In feeder cattle, we've pushed up against that 250 level again. We were there a couple of weeks ago. 251, 250 is a high. I don't know if we've got enough strength to push back to the summer highs, but certainly this is an area where you might want to at least take a look at defending price, especially with a little bit of an uptick in the market here this morning. And then finally, the hog market. Hogs have been on fire. We've had a huge push. We've got the RSI almost 65, stochastics in the upper 80s. Probably ought to be looking at protecting price here as well. We're still above the 9-day moving average. So if you want to ride this thing a little bit, watch that red line. And yeah, maybe it's going to continue to trade higher, but if we break below the red line, could trigger some selling. Then you got the blue line, the 20-day moving average, and then I've drawn this uptrend line in here as well, this gray line. So if you want to ride this thing, see how high hogs can go, that might, those would be some indicators where you might want to then turn and be able to make some sales. But hogs have been the market that's been as strong as any lately, with the exception of maybe soybean oil, palm oil. Those world oil seed markets have been on fire as well, and canola's been hot as well. So, but besides those, I think the hog market has been. So that's a quick update. What do we got coming up? Well, November 8th, what's that? Next week, end of next week, we've got our next USDA report. USDA will probably make a few tweaks to the production numbers, probably make a few tweaks to the demand numbers as well. So we'll get that on the 8th. We'll talk about it on the 11th in our aftermath. We've got the Thanksgiving holiday coming up at the end of this month. Keep in mind the PRF deadline, pasture, rangeland, and forage coverage for next year. That is has to be done by December 1st. Then we'll have our reports again in December, and then Christmas at the end of the month. So we do have some market holidays as well ahead of us. So with that, thanks for listening to this edition of the Thinking Cap. Hope you have a great day. We'll talk to you again very soon.